Welcome back. Having learned the theories of dividend policy, let's find out some of the factors that affect dividend policy in practice. We shall also learn the various taxation methods for dividends and how to calculate the effective tax rate on dividends. Let's get rolling. A company's dividend payout policy is the approach it follows in determining the amount and timing of dividend payments to shareholders. The CFA Institute lists 6 primary factors that affect a company's dividend payout policy. First, the investment opportunities. Availability of positive NPV investment opportunities and the speed with which the firm must react to the opportunities determines the amount of cash the firm must keep on hand. If a firm faces many profitable investment opportunities and has to react quickly to capitalize on the opportunities, the dividend payout may be low to have ready cash for opportunities that may come its way. Second, financial flexibility. We've learned earlier that shareholders expect dividends to be sticky. That is, they expect the dividends to be consistent. So rather than paying too much dividend in years with plenty of excess, some firms prefer to practice financial flexibility through stock repurchases instead of dividends as a way to pay out excess cash. Since stock repurchase plans are not considered sticky, they allow the company financial flexibility going forward. The company can choose to conserve cash in the years when it needs to meet unforeseen operating needs and investment opportunities. Third, the expected volatility of future earnings. Firms tie their target payout ratio to long-run sustainable earnings, so they're reluctant to increase dividends even in bumper years, unless reversal is not expected in the near future. Hence, when earnings are volatile, firms are more cautious in changing dividend payout. Fourth, flotation costs. When a company issues new shares of common stock, a flotation cost of 3% to 7% is taken from the amount of capital raised to pay for investment bankers and other costs associated with issuing the new stock. Since retained earnings have no such fee, the cost of new equity capital is always higher than the cost of retained earnings. Smaller companies typically have higher flotation costs as compared to larger companies. Generally, the higher the flotation costs, the lower the dividend payout, given the need for equity capital in positive NPV projects. The fifth factor is contractual and legal restrictions. Some companies may be restricted from paying dividends either by legal requirements or by implicit restrictions caused by cash needs of the business. Common legal and contractual restrictions on dividend payments include the impairment of capital rule. In some countries, dividends paid cannot be in excess of retained earnings. And debt covenants. These are designed to protect bondholders and dictate things a company must or must not do. Many covenants require a firm to meet or exceed a certain target for liquidity ratios and coverage ratios before they can pay a dividend. And lastly, tax considerations, which we've learned earlier under the theories of dividend policy that investors avoid higher taxes. Apparently, this theory of tax avoidance translates to real life. In countries where the tax rate on dividends is higher than capital gains, investors generally avoid high dividend stocks. However, note that the reverse is not always true in practice. In some countries, a lower tax rate for dividends compared to capital gains does not necessarily mean investors will favor dividends more. This may be due to the fact that taxes on dividends are paid when the dividend is received, while capital gains taxes are paid only when shares are sold. As such, some shareholders delay their tax payments. Also, in some countries like the US, the cost basis of shares may receive a step up in valuation at the shareholder's death. This means that taxes on capital gains may not be that high or have to be paid at all. And tax-exempt institutions such as pension funds and endowments will be indifferent between dividends or capital gains. Besides the effect of differential tax rates, another important aspect to examine is the method that a country adopts in taxing dividends. Across the world, there are 3 main systems in use: the double taxation system, the split rate system, and the imputation tax system. Let's study each of them. First, the double taxation system, which is used in the US. In 2003, the maximum tax rate on dividends paid by US companies to shareholders was reduced from 39.6% to 15%. Under the double taxation system, earnings are taxed at the corporate level, regardless of whether they're distributed as dividends or retained in the company's balance sheet. Dividends are taxed again at the shareholder level. Since dividends are first taxed at the corporate level, with the after-corporate tax amount taxed at the individual level, we can calculate the total effective tax rate as the corporate tax rate plus 1 minus the corporate tax rate times the tax rate on dividends. So, for example, if the corporate tax rate is 30% and tax rate on dividends is 12.5%, the effective tax rate on dividends would be a whopping 38.75% for the shareholders. As you can see, the double taxation system can be perceived as quite unfair to shareholders who receive dividends. One way to address such unfairness is to adopt the split rate tax system. A split rate corporate tax system taxes earnings distributed as dividends at a lower rate than earnings that are retained. As such, the effective tax rate on dividends in this case would be lower than the double taxation method because we apply the lower rate. The effect is to offset the higher tax rate applied to dividends at the individual level. So, for example, let's say earnings distributed as dividends are taxed at a lower rate of 20%. The effective tax rate on dividends is therefore just 30%. If you notice, this is equal to the corporate tax rate for earnings retained by the company, but in practice, they do not always have to be equal. Although this system seems more fair, it still does not address one shortcoming. That is, individuals at different tax brackets are taxed at the same uniform effective rate. For example, a high net worth individual whose marginal income tax rate is 40% would have been taxed less for dividend income, while a middle income individual whose marginal income tax rate is 20% would still be taxed 30% for dividend income. The imputation tax system strives to bridge this gap, such that the effective tax rate on dividend is simply the shareholder's marginal tax rate. So in this case, the high net worth individual should have effective rate of 40%, and the middle income should have effective rate of 20%. Essentially, taxes are paid at the corporate level, such that dividends that go to shareholders are not taxed a second time. If the shareholder's tax bracket is lower than the company rate, the shareholder would receive a tax credit equal to the difference between the two rates. If the shareholder's tax bracket is higher than the company's rate, the shareholder pays the difference between the two rates. For example, if both shareholders own 100 shares each and the company earned $1 per share, assuming that 100% of the earnings are paid out, they would each receive $70 of dividend after 30% corporate tax. The high net worth individual would have to pay an extra $10 in tax to make his effective tax rate 40%. In contrast, the middle income shareholder would receive a $10 tax credit such that her effective rate is 20%. Let's end with some practice. Cornelius owns 50 shares of TPP Corp, which had just announced a pre-tax income of $3 per share, which will be taxed at 25%. The company announced that 100% of the earnings will be paid out as dividends. If Cornelius's marginal income tax rate is 20%, determine the tax adjustment for the dividends to be received under imputation tax system. Pause the video now and work out your answer. And we're back. Let's first determine the after-tax dividends Cornelius should receive. After 25% tax, he should receive $112.50. Under imputation tax system, he should actually pay just 20% tax, so it should be $120. As such, he should receive $7.50 in tax credit. And that concludes this lesson on the factors affecting dividend policy in practice. In our next lesson, we shall learn some of the main types of dividend policies that companies employ. See you again.